few years, I've had upwards of 70 or 80% of my net worth invested in cryptos. Entrepreneurship is a nurture rather than nature thing. I don't really believe people are born entrepreneurs. My company had the opportunity to lecture in Edinburgh University and in Glasgow University to some of their finance students.
Honestly, I'm surprised that the universities had you come in to talk, because standard education system's not usually open to anything like trading, any sort of entrepreneurial venture. Sam Kavanagh, welcome to the Real Wealth Podcast. Thanks for coming along.
Thanks for having me.
And thanks for doing it in person. It's always much better than the Zoom stuff,
100%.
I think what I want to start is, from doing this podcast, I get a sense that most entrepreneurs fit in either two categories. One is, it's inherently within you, and from a young age, you're trying to find different ways and different ventures to make money. And the second category is more kind of like myself, where there's a sort of event that happens in life that's a catalyst that leads you on an entrepreneurial journey. Where do you fit in that? And give us a bit of background to you.
That's a really interesting question to start off with, because I feel like whenever you watch like these business podcasts and stuff like that, you've always got the people who are like, oh yeah, whenever I was a kid, I was always looking for ways to make money and all that kind of stuff. Unless you grew up in like a really prosperous environment, pretty much everybody's looking for ways to make money as a kid, whether it's paper rounds or milk round or whatever. I grew up in a working class village. Pretty much everyone I knew, even people I went to school with and all that kind of stuff, they're always looking for ways to make money. They're always looking for, hustles effectively. From a young age, it was only the kids who had, really wealthy parents or whatever who were getting an allowance. Like, I didn't get allocated an allowance every week or every month or anything like that. So I definitely did have the desire to make money, just to do things. I think as soon as you hit high school and you start to develop a bit of a social life, there's only so many times you can ask mum and dad for 20 quid to go to the cinema before they start telling you to beat it, right? So, from a teenager, I was selling bits and bobs on eBay and that kind of thing, but I wouldn't say I was like, born an entrepreneur or anything like that.
I think it's one of those where, you may have a desire early on to start making some money, but it's not like you're in an environment where you necessarily understand what's needed and strategies on how to do that. And certainly the education system, I talk about this at length, doesn't do anything to support that, because, the path for most is get a job, get employed. Can't do that when you're 13, 14, 15. And coming from a working class background as well, I didn't have anyone around me that would have been able to kind of show me the path of entrepreneurship and how it works and how you build a business, and the fact that can be a much more prosperous path than the standard education is, right?
I definitely think entrepreneurship is a nurture rather than nature thing. I don't really believe people are born entrepreneurs. We'll speak about trading and stuff, I imagine, at some point. The same, I don't believe people are born traders. I don't believe people are born athletes. You may be born with, when we speak about something physical like athletics, you may be born with a biological advantage or a biological predisposition to go on and excel in a physical realm. But when it comes to business and academia and stuff like that, I really don't think these people are born. I think it is much more nurture rather than nature. Mm-hmm. And growing up, my dad was self-employed, so he had a home improvements building company, and I had seen that, he didn't work for anybody, he worked for himself, and there's no doubt that played a part in it. I knew that starting a business wasn't something where you needed a, however many 1,000 square foot office in a city centre, you didn't need people running the phones X, Y, and Z. Him and my mum were running that company. She was doing his bookkeeping and all that kind of stuff as admin, and he was out on the tools. So there was certainly an element of that where that initial barrier, people have said to me when I was younger, like, how do you even start a business? That was never something that had been like a problem for me, because I knew it was very, very simple, very, very simple process to just go and open up a limited company to get an accountant. And my first ever accountant, when I was about 17 probably, was the accountant my parents used. And then when my parents switched accountant, probably when I was 18, I switched accountant, as well. So I had some connections there already. And that's why I would say nurture rather than nature.
Were you inherently aware that your parents and that dynamic was different to the other people around you?
Yeah.
And how did that kind of manifest itself?
When you come from a working class area, there are things that are kind of accolades, right? Like ex-council house.
Yeah.
Yeah. Or like self-employed. There are things like that. So you hear that kind of talk and, it's not boastful or anything like that, but there are just these little things that you pick up on. And it's funny you asked that question because it's just reminded me of two terms like that, ex-council house, self-employed. These are kind of things that when you grow up in a working class area on a council estate and that kind of thing, these things do actually kind of set you apart from the crowd a little bit because it's not the run-of-the-mill things to do. I definitely was aware from a young age that my parents were different in those two capacities.
Yeah. So as you started to dabble, and by the sounds of it, very early, you were talking about having your first account at 17, were your parents supportive of that, or were they still very keen for you to go through the formal education system?
Again, and this is another working class thing, isn't it, where there's going the academic route is seen in quite a high regard. There was a real desire for me to do well in my exams. My parents paid for a physics tutor and a maths tutor for me because I wanted to take those to higher. I was very interested in the sciences. And in that kind of environment, not a lot of people, my father grew up in Dublin in a working class home. My mother grew up in Edinburgh in a mining village, again, working class home. Not a lot of people in their periphery would be university or even college educated. It just wasn't the done thing. You would, leave school at maybe 15, 16, and you would go and get a job. That was the way things were kind of done. So there certainly was a desire for me to go into an academic kind of route. And I did initially pursue that. Went to study architecture at college, architectural design technology. I thought that's what I was going to do. It just so happens, although I enjoyed it, I wasn't all that good at it.
Right.
I could probably get a career in it and do reasonably well, but there was no kind of reaching for the stars, if you like. I wasn't going to be the next big thing.
What was it? Do you think that what skills were lacking for architecture? Was it a creativity thing? Was it a passion thing? What was the thing that you felt, right, this isn't a good fit?
Absolutely, it was a creativity side of things. I'm not a very artistic person.
Yeah,
I'm just not. I can draw things. I can sketch things, but my designs and stuff like that I would come up with were just so run of the mill, kind of basic stuff, and it was very evident from the people around me in that class who were the ones who were going to do really well and who were the ones who were just, they might get a job in architecture, but it'd be some standard job. They're not going to have a very interesting career trajectory. I fell into that category.
It's quite an interesting one because I don't remember ever a point at school where they sat you down and said, look, we've kind of assessed you over a few years here. We understand this is your skill sets. How do you feel about it? That this is an obvious career path for you. Most people have just said, right, what do you want to do? And you're supposed to know at that age what the next steps are.
Yeah.
It's inevitable you're going to have a few failures along the way, or not necessarily failures, but learning experiences of this isn't the right fit for me.
Absolutely.
The other interesting thing you mentioned, was just the concept from your parents, and certainly my generation exactly the same. They came from an underprivileged background where the likes of going to university and higher education was just completely out of reach. So they're working from a premise of this is how you get on in the world by doing that. But the reality is, increasingly in the modern age now, they may be doing that for your best interests at the time, but it's just an outdated premise, that further education. Now it's like, everybody and their dog goes to university, and generally what happens out the other end is you're going to be on a very low paid salary for a very long time.
Yeah.
and you've got all this student debt to recover, whereas there are a huge amount of opportunities to build something for yourself and create wealth in the long term.
Yeah, 100%. My company, I mean, we'll get onto a lot of this stuff, I would imagine, but my company had the opportunity to lecture in Edinburgh University and in Glasgow University to some of their finance students. We'd done some workshops with them. We'd go in and we'd connect up our news service, and we'd open up the charts on their projector. And when the US employment data comes out on the first Friday of every month at 1:30, we gave them a little lesson, and then we traded that live with them. And we had our news service blasting it over the speakers and all that kind of stuff. It was really interesting. But we would interact with people from Glasgow Uni or from Edinburgh Uni who were finance students. They had degrees in financial analysis and all this kind of stuff. And very recently, a friend of mine, another entrepreneur, he actually got in contact with me and said, I've just received a CV from a guy and he's listed your company as, some of the things he's done. And I thought, I've never heard of this guy. And I opened it up. It turns out he was the person I was liaising with at Glasgow Uni.
Right.
Now he's applying for a job as a waiter in my friend's restaurant. And I'm thinking, when we were in there and I'm lecturing these guys, I've never been to uni, I'm lecturing them on finance and trading and investment and that kind of thing. These guys are in maybe like a 5-6 year program effectively in higher education. And now he's graduated and he's going on to be a waiter.
This is where he's landed. It's sad, but the reality of the situation just now. And honestly, I'm surprised that the universities had you come in to talk, because standard education system's not usually open to anything like trading, any sort of entrepreneurial venture. It seems to be something that's completely lacking.
Yeah.
I went through 4 years at university doing finance and then done my MBA, and I came out the other side, and my first job, I had to manage accounts for this oil and gas facility, and honestly, I didn't know where to start. I had to figure it all out as a learner. I thought, what the fuck have I been doing for the last 5 years that I'm in this point? But it's just the focus that they put on education isn't always the stuff that's actually going to benefit you coming in the other end. I mean, I'm really negative when it comes to the standard education system, because I just think it's failing so many people. And it's getting worse and worse because they're not moving with the times, which was bad enough 10, 15 years ago, 20 years ago.
Yeah.
But now we're entering an age of artificial intelligence. The world is going to move forward at a pace that no one can keep up with.
The curriculum's always going to be a few years behind. Now, historically, curriculum's going to be a few years behind. People would graduate from architecture in 2010, and the operating systems and the software that they were using when they were, learning is maybe 2006, 2007 stuff. They go into the workforce in 2011, let's say. They're a couple of years behind. They need to be refreshed on all the operating systems and that kind of thing. Now, that gap is just getting bigger and bigger and bigger.
It's closing too quickly.
Because technology's developing at such a rate, software, the efficiency of certain things, it is crazy. So people are coming out of uni after having studied architecture for 8 or 9 years in some cases, including their college, whatever. And what they've been focusing on, AutoCAD and Revit and all that kind of stuff, is like stuff that was used maybe 8 years ago.
Yeah. It's just completely outdated.
Yeah.
Yeah, I mean, every week we're seeing new AI tools come out, and as a business owner, it almost seems like a full-time job to try and keep up with it. And if you don't, then there's the feeling that you're going to be falling behind.
Yeah.
So talk to me, like, your journey here. You started trading in 2015, I believe. What was the kind of period leading up to that led you into trading and sort of any other entrepreneurial things you were doing around that time?
It was very subtle. I saw an advert for a demo account, a simulation account online. I'm sure it was on a YouTube video. And it just said, you download this app, you get a free £10,000 demo account.
Yeah.
So I just downloaded the app and off I went.
Was that on Trading 212 app? Yeah.
It was indeed, yeah. So off I went taking random punts on random things. And as is often the case when there's no real money on the line, you do remarkably well and start to think, oh yeah, You know, I know how to do this. You know, I was very wrong, but that was the way that went.
And how did your kind of progression after that point? You know, you start with this dummy account and sort of getting your experience levels up, and then presumably the next transition is, right, I'm going to put some hard cash into this and I'm going to start.
Yeah. So the hurdle I had at that age was, I'm 15-year-old, probably 16-year-old at that time. So at that time, it's not legal to trade real money on the financial markets. So there was years of learning and studying things behind the scenes. It wasn't even legal for me to have a PayPal account and that kind of thing. You know, fortunately, I had my mum on side for a lot of this. So when it came to PayPal and various things, eBay accounts, whatever, my mum was always on hand to produce an ID and allow me access to certain things. But really, the first few years is just learning. And it was an on and off process alongside college and everything else, and the first company that I started. So the trajectory, you know, in today's day and age, with the availability of resources, your career trajectory in trading can be 12 months, you know. Back then it was not as smooth as that. It was years of trial and error.
And that has been a big transition, and I say this a lot on the podcast, that the opportunity for people to educate themselves now is so vast. You know, you almost have to focus yourself in on a subject because, you know, otherwise there's just too much information. But you don't have to go back that long ago when it was really tough to get into something. And I remember feeling like there was this magic wall up when I started looking at property investment, where there was things that I wanted to understand that I just couldn't get the information on.
Yeah, I mean, so there's a bit of an interesting paradox here, where the amount of information that's available is a double-edged sword, right? You know, when I was in school, you know, whether I'm 13, 14, if you were doing a research project, let's say you're in history class, you're doing a research project and you type into Google World War II, what's going to be the first 5 results that come up? You know, a Wikipedia page and, you know, some historical museum, you know, whatever. First 5 results, all resources. Now, with the explosion of internet entries and social media and all that kind of stuff, you type in World War II, what's the first thing you're getting? You know, World War II inspired TikTok and this, that, and the other. You've just got, there's so much more information that the quality of information that's available in finding that is actually a lot harder. This is why people who are providing resources, whether it be education or whatever, have to be so aggressive with paid traffic and even organic and all that kind of stuff to try and get in front of people's eyes. Because you type in property or whatever it is into social media or into a search engine, there's just so much.
Are endless.
There's so much information now available, and people get what I call, you know, analysis paralysis. There's so much stuff to look at that they just don't know where to go. So there's a transition period where information's so readily available that people almost don't need training and courses and all that kind of stuff. And then it gets to the stage where now there's so much that people are like, I just want to pay to have someone tell me, here's point A and here's point Z, just follow these steps, because otherwise I'm just drowning in a sea of information.
I'm interested to see how it's going to play out as we move forward, especially with AI, because at the moment you have a question, you type it in Google, you'll get 2,000 pages to look through. Okay, some of them will be prioritized, but there's a world of information there. But when you go over to something like ChatGPT, you put something in, there's one answer, and it's presented as the answer. Yeah, which is very dangerous in a way.
Oh, 100%.
Especially if you take that as verbatim, because quite often a lot of the stuff that ChatGPT will spit out is, you know, not the best. So it's a great opportunity, but it can also be confusing. And what we do on this podcast is we're exploring a whole variety of opportunities to grow wealth, based from the fundamental important elements, which are, you know, getting your mindset right, committing to something, becoming passionate about it, and educating yourself financially fundamentally, because if you are the sort of person who is always going to spend every penny that comes in, it doesn't matter how much money you make, you can't create any wealth.
Yeah.
So it's exciting for me to be able to explore all these different investment opportunities, and you're the first person we've had on that's trading.
Right.
So I'm really excited to get into that. That's not something I know very much about. So talk to me about your kind of trading history, moving from trading 212 to now you have KB Trading.
Yeah.
And that business that you have.
So alongside learning to trade, I was running a previous company which had nothing to do with architecture, had nothing to do with finance. We actually used to build and produce radio antennas. So me and my now wife, she was my girlfriend at the time, we used to kind of work together on that. And we used to sell these radio antennas all over the world. And, you know, we built a little bit of a culture and a brand around that in the action sports industry. So airsoft, paintball, that kind of thing, some private military guys. And we had great success with that for a first business. You know, I've learned so much about production lines and customer service and, you know, marketing and all that kind of stuff, Photoshop, you know, Premiere Pro, editing videos, all that kind of stuff. And that would really give me an excellent foundation for the business that I have now. Because as you know yourself, when you start a business, unless you've got, you know, seed capital or whatever, you're the marketer, you're the salesperson, you're the customer service guy.
Absolutely. And even when you're not, you still need to have a fundamental understanding of those things, right?
You can have the best staff in the world. If you don't understand how things work, their output, you can never demand X as their output if you don't know if X is possible. Because I have so much experience in all these areas, when I bring on a video editor and X, Y, and Z, I can say, I want this to look like this. Mm-hmm. And I know that that's possible, and he knows that's possible because it's his job. But I can ask, you know, him to jump a certain height, and he can then go and follow through and do it. So I was doing that alongside trading, and that I would always recommend to people. So many people have this idea, like, I'm going to become a trader, so what I'm going to do is I'm going to go and tell my boss to, you know, do one basically. Yes, I'm gonna go and tell my boss to do one, and then I'm gonna just commit to trading full time. No, you need to have, if you have another source of income there, it's gonna make that education process way less stressful. So I had an income from TCS, Tactical Comm Solutions, which was my other company, and it was going very well. So there was no pressure on me to make money from trading. Even in the short, medium, even in the long term, I had something that worked. And around this time, guys who I had known through that business, you know, customers, friends, affiliates, all that kind of stuff, they had seen that I was interested in trading, and they'd started giving me little pots of capital to trade alongside my family and all that kind of stuff. So, you know, very quickly, way before I should have done, by the way, I'm trading a few £1,000s, probably $5,000, something like that, which in trading isn't a lot of money. You know, right now I'm probably managing close to 7 figures, but at that time, you know, as a young person, trading £5,000, it's quite a big deal. So that really gave me boots on the ground, hands-on, real experience managing funds. And I'm very over-ambitious, I'm very overconfident and that kind of thing, which is, I think is a net positive. Mm-hmm. Because you're the type of person who just jumps in at the deep end, and okay, you're actually not quite equipped to swim quite as well, but what happens is when you do survive, you've got a great story to tell at the end of it, and also you're just pushing the limits. You're pushing the limits all the time. So I said this on a podcast recently, I started KB way before I should have. Now at that time, I knew probably 10, 20 times more than the average person, and I was beginning to see consistency in my performance and that kind of thing. But now I look back on who that person was, which is like 5 years ago, and I'm like, he knew nothing. Now he still knew 20 times more than the average Joe, but I now know 200 times more than he did. So I'm like, wow, you were really overconfident. But I was 19-year-old, you know? Yeah. So you're 19, you're starting to get a bit of success with this, and people are seeing the mystery around this and thinking, how is this even possible? And I'm like, it's actually super simple, let me show you. And so that's how KB started, you know, in 2019.
I couldn't imagine having the maturity at 19 to be able to manage a business and grow a successful business, and all the skills that you have to have. I mean, Laurie and I really didn't start our business until our early 30s, and as I say, I was kind of more on the latter end of, you know, this catalyst moment for me when I said, look, you know, I need to create something for myself now. But, you know, I can't imagine of having the skills necessary to do it in 19. So, you know, just to have had yourself in the game at that age is an incredible start.
You know, I definitely didn't get off to a running start. You know, there was periods where I was thinking, like, how do you actually grow a business? How do you grow a customer base? And, you know, there was a lot of trial and error at that time. But, you know, you learn on the job. That's always going to be the way, isn't it? You know, and that's the best way to learn. I didn't study business education in school. I didn't watch any kind of business seminars or get any business courses. I learned on the job. And in my opinion, that's the best way.
Trial by fire. Absolutely. I mean, there's a couple of points you mentioned earlier which I think are really important, that a lot of wealth strategies, and, you know, whichever industry you go into, there is always the good and the bad. And, you know, there's certainly within the property industry, there's a lot of people kind of trying to teach get rich quick schemes.
Yeah.
And it really just doesn't exist in business in reality, because, you know, okay, someone can strike it lucky, but in terms of consistent, repeatable strategies, there is a necessity to learn, grow, develop, move forward, you know, continually through a business. And I think it's just, it's something that is very dangerous when anybody's thinking about wealth creation, that they just jump in with both feet and expect immediate results, quitting their job, you know, instantly. We had, you know, our business is now about 5-6 years old.
Right.
And it was only the end of 2021, Laurie and I went full time, and by that point we already had 200 properties. We had, you know, a full team of staff in the office, and we were still only doing it part time, because we wanted to make sure that we had a strong foundation to build from. And, you know, as you start to develop into entrepreneurship, when you're a bit older and you've got responsibilities and kids and houses to pay for, you need to make sure that the financials are strong, you know?
Yeah, I mean, it's something I say to people as well, as, you know, that's a big question for a lot of traders, is when do you go full time? And I say to people, you know, if you're living at home with your folks, first of all, having them on side is a massive thing. They have to be, you know, we live in a generation that has no respect for authority, has no respect or honour for their parents. You know, they don't see value in these things. They think they know best. They think they know better than their parents and all that, and they want to go off and do their own thing, regardless of what mum and dad says. And for young people, that's the first tip I always give them, is make sure your folks are on side. If they're paying, you know, if they're putting food on your table, if they're paying for your clothes, if they're paying for the roof over your head, and they're paying for your heating and all that kind of stuff, you need to honour them, you know. And whether that's a case of, I'm not saying, well, just don't do trading if they don't want you to do trading, but get them on side, show them, you know, go and trade a simulation account for X number of months and build a track record and show them, look, this is possible, X, Y, and Z. But the next tip is to have, if you're a young person, you're living at home, to have like 6 months of income saved up from your job, right? As well as being consistent, and that's a necessary precondition. But if you're over the age of 30 and you've got people dependent upon you, you've got kids, you've got a family, you've got a mortgage, that 6 months of income saved is going to maybe look like 18 months, you know, realistically. Why? Well, because what happens when something goes wrong, what happens when there's damage to the roof, or, you know, you get a car crash or whatever, and you need the money on hand. So as you crest that hill of like 30 years old, you have less room for error. When you're young and you're at home and that kind of thing, you can take much bigger risks with your business journey and all that kind of stuff. And that's why I always recommend people to start as young as you can in whatever venture it is you want to do, because you have so much less to lose. So, you know, you can burn out and you know, blow up effectively at 18, 19-year-old, and 2 years later you've recovered it, 3 years later you've recovered it.
Those lessons are much more painful in your 30s than your 40s.
Yeah, because you have people dependent upon you. You know, I just recently, my wife just recently gave birth to our daughter. So
Congratulations.
thank you very much. So now that's all the things I'm thinking about. You know, I'm like, I had a joke with my wife Neve as we were going out last night, and I said that's paragliding and bungee jumping, you know, out the picture now.
Off the
Right, she's like, were you ever gonna do that? And I'm like, probably not, but definitely not now. You know, now I've got a little one to think about.
It has such a fundamental change on your life and the way that you look at it. I don't know if it's more. I can only speak from a male perspective, to be honest, but the responsibility you feel for your children, their well-being, their financial well-being. You know, I'm already thinking. I mean, my kids are still pretty young, 3 and 1, but I'm already thinking about, you know, trust funds and building up investments for them and all that sort of stuff, because it is such a huge responsibility.
Yeah.
So, talk to me about KB Trading, what you do, the support, training, and mentorship. You know, you've already talked about some of the advice that you give to people coming through, but talk to me a bit more about KB Trading and how you're supporting people.
Yeah,
The community.
So KB Trading really started out as just like a group chat, effectively, where I would share insights about what I was doing in the markets. That very, very quickly grew. There was demand. People were desiring to have a bit more of a comprehensive learning structure. That led to us releasing our first course, probably in 2020, just a PDF document, which laid out all the foundations, all the basics of trading, if you like, which progressed into a video course, which progressed into, over time, a trading floor. So we had multiple trading floors in Glasgow. At max, we had about 12 or 15 traders actually on the floor, teaching those people in person with the intention of backing them with my own capital and them trading money for me alongside me trading, and us trading a kind of collective pool. You know, that very quickly we became recognised, certainly in around Scotland, Glasgow. We were invited to speak in universities and invest in various trading and investment societies alongside some of the big institutional players like JP Morgan, etc. Speaking at financial expos and conferences, some of the biggest financial expos in the world. And, you know, a lot of this is kicking off. I'm, 21, 22 years old, so it's a lot to take in. But very quickly, as our understanding and approach to the market became recognised as something that was very, very good and not only worked, but is also very future-proof, very, very quickly, there began to be a lot of interest and buzz around what we do. And so what we mostly specialise in now is online education, mentorship programs, courses, that type of thing, to get people from either, we don't really focus a lot on your novices, although we have started to a bit more. But over the past couple of years, the main focus has been like guys who are been trading for a few years and they're struggling, getting them to the professional level where they're doing 5 figures a month, that type of thing. That was our kind of speciality, taking people through that process. However, in the past maybe 5-6 months, we've began to also focus on those people who have never heard of trading or in their first couple of years and get them to that intermediate stage. So that's kind of what we do.
How have you found the sort of power of community around it? Because the journey of any of these types of investments, whether it be trading, property investment as well as similar, can be quite a lonely one if you're doing it on your own. And we've found, certainly within our property business, that pulling together a community of people that are all heading in a similar direction has been massively powerful for everyone.
It's fantastic. It's absolutely fantastic. Trading's a lonely game.
Mm-hmm.
Very, very lonely. You know, it's really just you and the charts. And whatever your profit and loss looks like at the end of each day, it's you and that figure. Being in an environment, you know, it'd be great for me to sit here and say, you know, like you see these guys on social media, oh yeah, we win 90% of the time and all that kind of stuff. And Dr. David Paul, a fantastic trader, one of the legends of the game, he's passed away now. He said, you know, most professional traders would sell their granny for a 65% strike rate.
Yeah.
The reality is, in currency trading, a strike rate of, you know, 45 to 50% is where most, even guys at the top of the ladder land. So obviously with asymmetric risk rewards and stuff, that turns out to be profitable over time. But the reality is, if you take 100 trades, in all likelihood, you'll lose maybe 50 or 55, and you'll win 45. So losses happen more frequently than wins. Obviously, it's about managing those losses so that they're smaller and your wins are bigger and all the rest of it. But that can take an emotional toll, especially if you're trading in a vacuum, if it's just you in a room with a computer. So having a community there, wow. I mean, because you'll get people who'll come in and you'll see them put in a message, I can't believe that trade lost. And you know that they're actually sitting behind their charts, like, head in their hands. And so people come in and kind of pick each other up and that kind of thing.
It's a funny thing that, because of social media, generally, a lot of people are only seeing the positives and things, and it can create a massive mindset hurdle to get over at the start for anybody that's getting into investment, because you have to learn to take the good with the bad, and the amount of people, I always say this, one of our biggest challenges when people come to us for property investment training is getting them over the mindset battles, 100%, making them understand that there's no get rich quick schemes. This is long term, it's tough, it's a big learning curve, there will be issues along the way that you're going to have to get used to dealing with. That is just life in business.
Yeah, absolutely. And because the expectations are so high coming in, there's this kind of left curve, right curve type of thing where people come into trading and they're like, I'm going to be trading for, 10 minutes a day, and, I'm going to be making 5 figures every month and all that kind of stuff. And then as they progress through that curve, they get to a point where they're like, trading takes up your whole life, and, if you're lucky, you'll make an income. And then when you get into the professional side, you're like, wow, I do kind of trade for less than an hour a day, and I do make 5 figures a month. So it is a progression. When you hear a professional, and when I say professional, I don't mean the guy, on Instagram with a rented Ferrari outside the Burj Khalifa,
much of it.
I mean actual professionals with verified track records. When you hear them say they have a system that they operate for 30 to 60 minutes a day and they pull 5 figures from the market, they can prove that with a verified track record. That's legitimate. When you see the guys on the other side, beginners, novices, whatever, coming in saying that's what they expect, you have to give them that reality check, because in any career, even in property, there will be opportunities that once you're established in this game, there will be opportunities that literally land on your lap, and deals that you have in and out and make a really good return from, and you're like, almost like, wow, where did that come from? That happens in trading as well. But if people come to you and they're expecting that, you have to give them that reality check, and it's the exact same in trading as well. But having that community, again, it brings people down a peg. They have all these expectations and it brings them back. It's something we really like to do, and we started doing it last year. We're going to do it every year now. In December, we send out class trophies to our top earners and that kind of thing. Guys who have done 5 figures in the markets, guys who have done 6 figures within that year, we send them out a glass trophy. The sense of community that builds, and everybody's now looking up to these guys, and it inspires everybody else and all that kind of stuff. Community in business and trading is excellent.
Couldn't agree more. Absolutely. What are your favourite instruments to trade? And does it move? Is it a moving target?
Wow. I mean, if you ask me every 6 months, that's going to change. My favourite instruments to trade, what my favourite instruments to trade and what I actually trade are 2 different things. Because that's another mistake that people make. They want to do what they like in the markets, but what you like doesn't always work. The most enjoyment I had out of trading, but equally it was some of the worst, psychological and draining period, was when I was trading financial futures. I was trading European bonds, so the German Bund, 10-year government bond. I was trading the Euro Stocks 50, the DAX 30, which was, it's the DAX 40 now, FESX, and as the Euro Stocks and the futures. So I was trading futures, and I was trading on the very, very short term trading order flow. So, all my screens up with all the order flow, footprint charts and depth of market and all that kind of stuff. It was great. It was like being a detective, because every day you're coming in and you're locked into these charts and you're watching every single order come through the book. on the Eurex exchange. Great fun. But what I actually trade is currencies now and commodities, not in the futures market. I trade spot currencies and commodities. So not exactly my favorite thing to trade. It can be boring at times.
Yeah.
But what's boring is often what works, and what's exciting is often not what works.
Yeah. It's an unfortunate truth.
Yeah.
On the commodities front, any particular favourites in there? I'd done a podcast recently on gold and silver.
Yeah.
Unfortunately, didn't have anyone to come in who was a professional to talk about it. It was just me kind of doing some investigation. Don't invest in it, but I'm interested in it and some of the kind of fundamentals of it, right? The fact that, gold and silver tend to kind of follow each other. Gold does quite well in an economic downturn, and silver tends to be dragged up with gold. The interesting thing for me about silver, though, seemed to come in terms of its industrial use. So you can see an opportunity going forward, particularly with like lithium batteries becoming a massive thing with electric cars. Silver's heavily used in that industrial process. You could see how silver could start to do quite well in a good economy as well, when industry's booming, as well as, getting the benefits of gold in a...
The thing about silver and gold is, when we talk about them doing well or doing poorly, financial instruments and commodities are priced in US dollars.
Yeah.
So gold never actually does poorly or does well, right? In the same sense that other things do poorly or do well. Like watches as an investment or whatever is an investment, they'll go through supply and demand changes, where the company produces more and so the value goes down, or the company makes a model discontinued and so the value goes up, whatever. With gold, you can't print gold, you can't make more. Yeah, of course you can mine more, but gold is finite. So gold is always going to be a store of value. This is why on poor jobs reports and GDP and all that kind of stuff, gold tends to go up, because it's a store of value. When people lose confidence in the economy, put money in gold. I saw an interesting chart recently, and I'm kicking myself that I didn't go back and check what it was, because it would have been great to bring up now. But effectively, this chart showed how much a house would have cost you in like 1950 in US dollars, and let's say it's like $5,000 or something, and the same house in 2023 is like 500,000. Just throwing out random figures here, and it shows you how much gold would have been required to buy it in 1950.
Yep.
And how much gold would be required to buy it now. It's the same amount of gold.
I seen that, and actually I spoke, because I had Donald Cameron from Crypto Glasgow, and we were talking about Bitcoin in the context of its formation as a gold equivalent digital currency.
It's a great comparison.
And it was something like, average property price in Scotland back in 1970s, say, was about $4,000. Gold at that point was 200 odd quid an ounce.
Yeah.
Fast forward, so you're talking about 20 multiples to get a house back then. Fast forward to now, average property price in Scotland's probably about 270 grand, and the price of gold is 1,600. So the multiple has considerably extended, and that's just a good representation of the cost of living ultimately, and how badly inflation has hit most people.
This is the problem with, traditional currency, because you can just turn on the money printer, and that's never going to be a good thing. We saw in Zambia, or was it Zimbabwe, in 2008 or 2009, when they had hyperinflation of like 5 trillion% or something like that.
Yeah.
And people are going to buy a loaf of bread with a wheelbarrow full of cash. It kind of echoes the Great Depression. It's crazy. The fiat system is very, very broken. But commodities, this is why commodities are such an interesting market. When we think about commodities, we think about the typical, oil, we think about gold, we think about silver. But there are some outliers there that don't get a lot of attention. Things like sugar, things like wheat, and these don't get a lot of attention, but these are fantastic markets to be looking at. And they're markets that aren't speculated on a whole lot by your average retail investor.
Yeah.
But they're very, very interesting markets, especially when there's food shortages, especially when there's food crisis and stuff like that. Sugar and wheat go absolutely parabolic. Another commodity that's certainly very interesting to look at is copper. When I was running the trading floor back in 2020, one of my junior traders submitted a report to me. I had asked them all to do reports on a commodity or an upcoming asset class that they thought had weight. And one of my traders brought me a full report on copper, full justification for what he thought copper was going to do over the next 5 years, based on, his premise was the use of copper in batteries for electric vehicles and that kind of thing. And wow, he was right, and I'm kicking myself that I didn't put money into copper, because he was right, and he was right big on that investment idea. But copper is another really interesting one.
Excellent. I think, for me, I love to look into these things. It's not something we're active in because we're so heavily involved in property, but there are certainly a few investments that we look at make in the next little while. I think between Don and Deck, they've certainly started to twist my arm towards crypto, which is I just like the fundamentals of where it's heading. I'm very scared about the fiat system. I think Robert Kiyosaki said a little while ago that when Nixon took us off the gold standard in 1970, that was a death of an empire at that stage, and it's playing out okay. It might be taking a while, but
yeah, you're absolutely right.
So I because of that, and because of my concerns over central digital currencies, which seem to be an inevitable path we're on, I like the idea of placing some money in crypto in the long term. It's just horrendously volatile. What's your thoughts on crypto? Now, obviously, now we've got the Bitcoin ETF, which kind of brings it into the trading world, which it really wasn't intended for, but that's where we've landed. What's your thoughts on it? Is it something you're looking at? Is it?
I have a digital asset portfolio. At points in the past couple of years, don't try this at home, kids.
Not investment advice.
Yeah, this is not financial advice. Don't sue me. At points in the past few years, I've had upwards of 70 or 80% of my net worth invested in cryptos and in digital assets, which sounds insane, and it is. But I am very much of the idea I don't dip my toes in the water ever. If I'm gonna get into something, I'm gonna risk the farm on it, which is something I advise everybody against. It's trading 101, it's basic 101. But when you've established a bit of a career, you can take bigger risks. When you've got capital behind you, when you've done X, Y, and Z, you have systems and strategies that work, and you know that worst comes to worst, you can recover this in a couple of years, whatever it may be. You take bigger risks, and you make bigger plays, and you make more money when you're right. And so I have been considerably invested in crypto over the past few years, definitely.
What about the kind of difference between sort of people like Warren Buffett who are investing for the long term? They're fundamentally looking at equities and saying, right, these are undervalued by the market. I'm going to take a long term position, versus trading. What is your view on it? Do you ever take a long term view on anything? Is it all kind of much more focused on day to day trades of commodities or whatever? Julie,
Yeah, so the more capital you have, the longer term you can trade feasibly. Your average long term investor, if you're long term investing and you're not making more than 10% per year, and you're investing in different companies, instruments, etc., you should stop and you should put your money into something like the S&P 500. The S&P 500 averages 10% a year over the past 100 years. So in investing, your goal is to beat the S&P. So if you have a stock portfolio and you invest in various pharmaceutical companies and all the rest of it, you need to be making at least 15% for it to be worth you actually using up any mental capital on doing that, rather than just investing in the S&P. If you have a bankroll of, a few $100 million, doing 10-15% a year is great, and it's relatively stress-free, especially if you're investing in, decent market cap instruments and assets. When you don't have, tens of millions, hundreds of millions, you really need to be looking at the short term, because you're going to have more opportunities and you're going to realize gains on a more frequent basis.
Yeah.
Now, there is a limit to that. That doesn't mean we should all be looking at 1 second charts on, the euro dollar or whatever. But typically, I'll take about 200 positions over the course of a year. Some people think that's really like, a low trade frequency. Some people take thousands. I'll take about 200 trades over the course of a year. My average trade time for a winning trade is about 1.5 days, 1.5 days. My average trade time for a losing trade is about 0.73 days. So it's just under a day, just under 75% of a day. So that's my approach, much, much shorter term. And the difference is you're in and out, you're taking risk on positions on a day-to-day or on a week-to-week basis, rather than taking a position with a long-term outlook. So you're realizing decent gains over a shorter period of time, but your risk is also increased, because for those 200 trades that you take, if you're risking 2% on every trade, you've risked 400% for the year.
Yeah. Do you have preset parameters over levels of loss or gain per property? So you've figured out buy it, sell before you enter it?
Yeah, so I'll always have a predefined risk of, it depends on the account I'm trading. On my own funds, I'll risk 4% per opportunity that I take. I also trade funds for proprietary trading firms. So, with one firm from Czech, I've got like $300,000-$400,000 with them. Another firm from the US, I've got $400,000 with them. On those accounts, I'll trade much lower risk. I trade with a firm based in New York. I've got about $230K with them. For the longest time, I was risking just 0.4% per opportunity, 10 times less than I risk on my own funds. But whenever I go into a trade, I have a predefined area that if the market goes to there, I will get out of that trade and realize a loss of X amount of percent. Always.
I think, through that, it raises something with me, which was a fundamental misconception that I had about trading before I started to look into it. We went into property for two reasons. When we started our kind of entrepreneurial journey, one was, just a really fundamental view of, right, what is the biggest transaction most people make is their house. There has to be a lot of money to be made in that. And the second reason was the ability to leverage debt within property is fairly unrivaled versus other investment opportunities, because it's seen as a safe, solid asset. It's not massively volatile. And, if you listen to gurus like Robert Kiyosaki, the way that people get rich is by leveraging debt, good debt that is paid for through assets. So that's why we went down that route. And I would have always said, okay, we're trading, you don't get the same debt leverage, you can't debt leverage, but, I've found through the process of looking at this, you've got prop firm capital. So tell me about that and how it works.
It's interesting you mentioned leverage. A little note on that. So go back 8 years in the UK, the FCA hadn't fully cracked down on retail trading and investing all that much. Brokerages would offer you leverage of up to 300 times. So for anyone who may not understand that, for every pound you have in the account, they'll let you move £300 worth. And then ESMA regulation came in around 2016, which spanned across, I believe, most of Europe, certainly the UK, where leverage was then capped to 1 to 30 in the UK to protect retail investors. As a professional, I get access to 1 to 500 leverage, even with FCA regulated brokerages. The type of broker, you go to them, you ask them for an account, they give you 1 to 30, I get 1 to 500. The downside to that is I have no insurance on funds. If you, as a retail investor, open an account with an FCA regulated brokerage and they go under tomorrow, you're insured up to $80,000. Me as a professional, I assume that risk. So it's incentivizes against keeping a lot of money in the brokerage, obviously. But for every pound I put down, I can trade 500. So you are effectively leveraging debt in a sense. There, you're using the broker's money to take position sizes 500 times bigger than you actually can afford on paper. And that allows you to trade much bigger size and to scale an account much, much quicker. If your average retail investor is trading 1 to 30, 1 to 25 leverage, I am trading 20 times more leverage than that.
Yep.
I can make 20 times more money from one move, Prop firms. Prop firms are probably the best thing that's happened to this industry. Prop firms in its truest sense is not what we actually see today. Proprietary trading firms became popular when trading moved out of the pits. Back when traders would communicate in hand signals in the pits, they'd be communicating with brokerages. They'd be, you get the gist. Anyone who's seen Ferris Bueller's Day Off, they'll remember that scene where Cameron's, mimicking all the hand signals. When trading moved to electronic, the ability for wealthy investors to back traders with capital and to monitor what they were doing in the markets, impose risk limits on them and all that kind of stuff grew. So it grew a culture where traders could now come together in an office somewhere in London or in a city, and big wealthy backers could come in and fund that firm with millions, and they would employ risk managers and everything else, and these guys would trade that money in the markets, and that was real proprietary trading. Now, there'd be a process to get there. You'd start very small on simulation, then on 5,000, then on 10,000, then on 20,000. Most guys didn't even have their own computer. They'd share a computer with another junior trader. They'd be paying $2,500 a month just to work at the firm.
Wow.
I mean, the odds were against you. And what would happen is, over a 10-year career trajectory, people would, maybe 5 years into their career, they start making decent money. And then from there, they end up, doing 6-figure, 7-figure years pretty quickly. So it was really a process that you had to commit to, like anything. With the advent of online prop firms, which became quite popular, maybe 2015, 2016. I say it became popular. They came on the scene around that time. They became popular in the last maybe 4 or 5 years. Now firms are saying, what we'll do is, you can pay us 500 quid and we'll give you a demo account of $100,000. And if you make 10% over the next month on this demo account, we'll give you $100,000 to trade, and 80% of everything you make, you get to keep. Sounds great. However, 90% of traders lose money. Mm-hmm. So now what these prop firms have is, every 100 people that come through that prop firm, only 10 are going to pass. Of those 10 who pass, maybe only one of those will ever get to the stage where they take a payout from the firm.
Yep.
Because trading's tough, it's tough. So what actually ends up happening is, out of every 1,000 people that pay 500 quid to sit this assessment to get funded with proprietary trading capital, maybe 10 will actually ever make money from that. And all of the money that's been generated from people sitting these assessments just grows the firm and grows the firm and grows the firm. So it's almost like, it's almost like buying raffle tickets.
Yeah, to see if you're going to make it.
Yeah.
But presumably through this analysis that they do of your capabilities, there's talent, dedication, all those sort of things that can get you through, right?
If this is something we specialise in as well at KB, is getting people through the proprietary trading assessments, because once you get to the stage where you can start passing these assessments, the sky's the limit. If you're funded with, I know people, some of my clients are funded with 3 million, 5 million, all that kind of stuff. A decent year in the markets can be 30 to 50%, Now, you look at that on $5 million, that's, you're taking home a decent pay packet from that.
How does it work on the other side if you're trading and you lose with a prop firm? It's their capital, it's their loss.
It's their capital, it's their loss. Now, not all prop firms are actually funding you. This is something that a lot of people don't realise. So I can give you a hypothetical $100,000, knowing that, only 10% of everyone who sits this assessment is going to pass. And of the 10 that pass, only one is ever going to take a payout. If I have my maths done correctly, I don't actually, if you pass the assessment and the other, if you're the 1 out of 100 that takes a payout, I can do my maths and say, over your trading career on this 100k account, you're likely to make 30% before you lose the account, because you break a rule or whatever. So I need to make sure that the other 99 are paying me at least 30 grand, because that's going to cover your payout.
Yeah.
Now, the average payout from a trader is probably not 30 grand, it's probably about 3. So what that means is, I don't actually need to fund you with any money. I can just give you a demo account, a complete simulation account, and if you make money, I'll pay you, but I can just pay you out the other 99 who have given me 500 to sit the challenge.
Yeah.
So in many cases, the firms aren't actually assuming any risk in the markets. You sit this challenge, you get a demo account, and if you make money on it, they'll pay you anyway. And because 99% aren't going to be withdrawn money, the firm's always going to have money to pay you. So, it works great for everyone.
Yeah.
The firm actually doesn't have a whole lot of risk, and you get paid because you're the 1 in 100 that's good enough.
That made the cut.
Yeah.
Talk to me a little bit about strategies around picking trades. I've heard about discretionary versus systematic and the different types of approach that you can have. So where do you fit? And maybe for our listeners, give a bit of background to what those are.
So my mentor is a discretionary trader. Now, how to give an analogy of discretion versus systematic. I gave this analogy on a podcast recently, and it's like, I don't know if you're into fishing or anything like that, but guys who will be into like freshwater fishing, you'll have your discretionary traders, your fishers they'll read the banking and the flow of the river and all that, and they'll bait up and all the rest of it, and they'll cast that fly into the exact spot where they know the fish are likely to be. And they've put all this energy and time into determining that exact spot, and that's where they believe the fish are going to be. The systematic trader is the guy who says, this stream moves this way, and it comes to a choke point here, I'm going to sit one net at the bottom of it. And okay, that guy, maybe in that time he's got 5 or 6 fish and you walk away with 2 or 3 in your basket, but you've been there for less time, you've just got what you believe is the natural flow of things.
Yep.
and you've done one. He spent all this time and skill and energy and all that kind of stuff. Now, he can make more money. Discretionary trader who's good can make more money easily. The mechanical trader will make less money, but he also has to put in a lot less time. And when he goes through bad periods in the markets which come, it's much easier to work out what he's doing wrong. A discretionary trader will have an arsenal, he'll have an inventory of different approaches and, strategies and that kind of thing. And he'll look at the instruments he trades, and he'll be identifying certain setups in each market, and he'll be trying to take them, and he'll be applying different risk scaling strategies and all that. If he goes through a bad period, it's very difficult to work out if he's the problem or if the strategy is the problem, because it's like you would do in chemistry class. You would have a constant, you would have your constant, and then you would repeat the test 5 times in the exact same manner under the exact same conditions. Nothing should have changed. If something changes, you go, what did you do differently on that? Oh, actually the Bunsen burner only heated up to 36 degrees instead of whatever, right?
Yep.
So you can identify what the variable was. With systematic trading, it's exactly the same. Because we have a data-backed system, we have a system that we've tested over 7 years of market data through various sampling processes. We know this is the rigid system, and we just apply it to the markets on a day-to-day basis when those setups appear. So if something goes wrong in a trade, we can go, hold on, I didn't actually apply that step, and therefore I lost money on that. We can see where we've gone wrong, or we can say, no, we played through the strategy. All that's happened is the markets just weren't, meshing so well with our system. That's a real difference. But my mentor was discretionary trader, 22, 25 years probably now, market experience. His ability to read the markets is second to none, and I inherited quite a bit of that from him. But what I found running a trading floor was, it's very difficult to teach someone market read, it's about like we spoke about with art and stuff like that. Some people have that artistic eye. They can look at, some landscape, and they can see all the ratios and the symmetry and all that kind of stuff, and you're like, really?
How does your brain work like?
Yeah. Now, in I can look at a market and I can tell you, you know, it's going to go to there and then it's going to go to there. You know, a large percentage of the time I'll probably be right. But teaching that, communicating market read to someone, communicating an artistic eye or an eye for X, Y, and Z, an ear for certain music, you can't communicate or teach that to people. So someone working under your wing for many years may start to inherit that from you, like I did from my mentor.
Yeah.
But it's a very difficult process. So through running the trading floor, we ended up developing totally systematic, mechanical approaches to the markets where you can apply it and I can apply it, and I know if you've been applying it correctly because your results are the same as mine. And if they're not, I know you've not been, you know.
So, you know, if I'm understanding it correctly, then systematic approach is quite heavily driven on historical movements.
Yeah.
And this was an interesting conversation with Don on the crypto front, because I was asking him, you know, what their expectations was or are in terms of how Bitcoin and other cryptocurrencies will do when the market slumps, you know, when economic conditions are not great, or we have a financial crisis like we did in 2008. And he was like, we don't know, because it's only come about from 2017.
Yeah.
It's relatively new. It's not been through, you know, a huge amount of market kind of cycle. So we don't understand it that well at the moment. It tends to act more like a tech stock than anything else in comparison. The interesting thing for me is, again, I'll go back to AI, just because I feel like it's dramatically going to change the world to a point where we can't necessarily understand what's on the other side. Is that something you've thought about in terms of, you know, being able to predict, you know, market trends and cycles going forward, or, you know?
Yeah, so the future is never going to be, you know, a mirror image of the past or anything like that. But the marketplace is shifting and changing on a year-to-year basis. You know, every economic cycle, things do change. But what we find is that the foundations of the way the markets move and stuff like that, they tend to change really very little. You may see differences in price movement. Price may move within a niche in the market based on macroeconomics, but over time, they tend to level out and do a similar thing to what they've always done. So when we build systems, we are not building systems that have been fitted. This is a term in trading that's used on the data analysis and interpretation side. We talk about curve fitting or overfitting a system. And that's when you take, you know, a date from point A to point B and you build a strategy that worked over that time period.
Yeah.
What's the problem with that? Okay, you've got a strategy that's made, you know, 1,500% over that period, and it's great, and it's got a 100% strike rate. But what you've done is you've taken a data sample of something that's already happened, and you've just tweaked and tweaked and tweaked to make that strategy fit that data sample.
Yeah.
What happens when you test that now on a future data sample or a past data sample? There's going to be a disconnect, because you've fitted that, you've tweaked that for that specific market environment. So when we build systems, we go through an in and out of sample approach. So we'll test recent market data and we'll build a strategy over that. And then we'll apply that strategy to a cross-section of market data from 5 years prior and see what happens. If it works in that data, which is completely different, what that tells us is that this strategy is robust, and the mathematical probability of that continuing to work in future is good. Whereas when you fit a strategy for a data sample and you test it on a previous historical data sample, you'll often find that it won't work.
Right.
And so the likelihood of that working in future is actually dramatically lower.
Right.
So that's how we would approach, you know, working out what's going to happen in the future effectively.
Okay. So no crystal ball involved then?
No crystal ball, no moon cycles, you know. I hear guys all the time, you know, talking about, even educators and stuff like that, and they're talking about how to predict the next move and how to call this and how to forecast what's going to happen. I mean, if your ability to make money is reliant upon your ability to predict the future, it's no wonder that 90% don't make money. And this is why, you know, I'm constantly face palming. I'm like, they're saying, oh, this is going to happen and that is going to happen and all that. And I think, how do you know?
Yeah. It's trading is an area where I mean, it was clear to see after the 2008 crisis, most people just didn't understand what the fuck happened. And I always kind of guide people to documentaries like The Inside Job by Charles Ferguson, because it gives a really good, coherent understanding of how we got to that position. And I think that's a challenge for a lot of people in looking at getting into trading and going forward is, you know, there's a lot of jargon that comes with it. There's a lot of potential complexity around it. What would be your advice for anybody that's looking to start out in trading?
So trading is one of those things where, you know, it's a bit like, you know, when you studied maths in school, right? You'd study, you know, Pythagoras, and you'd study this, and you study quadratic equations, and you study, you know, about a massive spectrum of things. And then you go out into the workforce and you realise that there's just some little cross section of that curriculum that you're just going to use forever. You know, in your day-to-day job, whether it be simple arithmetic or whether it be, you know, algebra, whether it be Pythagoras or whatever. Trading's the exact same. You know, there's a spectrum of stuff out there to learn, and what you'll find is that in your education initially, it'll seem like you're going very shallow and very wide. You're going very shallow and very wide, and then when you find the area in that spectrum that you want to specialize in, or you find an edge in, you then start to go very, very deep and narrow into it. So, you know, when you begin your study, shallow but wide, and then when you find that area within trading that you want to specialize in, you'll go very narrow and very, very deep into it. And, you know, there's an advantage to learning a wealth about the markets and that kind of thing, because then you'll find the little areas that you slot in. You know, it's about like a career fair where you go around from table to table and you speak to the people who work with the guide dogs, and you speak to the police, and you speak to X, Y, and Z to work out what career it is you want to do. It's the exact same thing in trading. It's worth exploring a lot of what's out there before finding what it is that you think clicks with you, and then going pretty deep into that. But the only advice I would give to people that don't want to do that is find someone that's reputable with an audited, verited, live public track record, and just jump under their wing and learn from them.
Absolutely. You know, it's a similar thing, you know, within the property industry. You know, there's a lot of negativity around training and mentorship, you know, in the industry. And we'll talk about that in a minute because I think it's an important point. But genuinely, you can learn so much faster, avoid so many mistakes, and get to the guts of the investment strategy when you have someone showing you the way. Even in our business journey just now, we're always looking for someone that is ahead of us in the game. What else can we learn? What's the next level? You know, we're lucky enough to have a few business partners that have built and sold multi-million-pound companies, because we can learn so much from those guys, and it's just a ticket to fast track, really. And you know, no investment strategy and learning curve is, you know, a short term thing, but you know, you can speed it up. For anybody that's watching the video on this, I wasn't having some mild heart attack when Sam was speaking. I hope it wasn't distracting. I had cramp. I was playing tennis this morning. So on that note of the last point, I want to talk about this BBC documentary, InstaTrader, because the BBC pissed me off when I watched it. And I can imagine the whole process pissed you off. And, you know, to give you my 2 cents, and for anybody that doesn't know about it, you were part of a documentary. It's very clear from me watching it from the outside that the BBC have went in with a narrative. There's been no objective reporting within that. They've went there to tell a story that was predefined. And I can imagine they cut a lot of shit that was not conducive to their message they were trying to send. And the reason why that annoys me is, well, several. One, we have this all the time within the property trading space. And, you know, there are genuinely people out there who are not providing value for the money that they charge. And, you know, there was a big expose on Samuel Leeds with Joe Lyson before. But there are also people out there that are making real differences to people and helping them create wealth and grow their knowledge and expand. And I think the narrative of the media is always going to be this one-sided view of this is wrong, people are getting scammed, you know, that this is too good to be true. And I have a fundamental issue with it. The second big issue I have with it is the constant view of the media almost seems to perpetuate keeping people in their place, you know, keeping people employed. You know, anything else out with that is a scam. Don't do it. Yeah. You know, don't try and create generational wealth. Don't try and break out of the system and avoid paying the hideous amounts of tax that employees have to pay. Just stay in your little box. Yeah. And I feel like that's the narrative of the media. And you have to remember that, you know, a lot of these media agencies are owned by individuals and they have ulterior motives. So
absolutely,
it pissed me off a bit. Yeah, and I could imagine being in a similar situation where we are trying to send the positive message of all the good that we do with our clients and the fantastic progress some of them have made, to only then be, you know, basically a victim to a narrative.
Yeah, so, I mean, it's socialism, isn't it? You know, it's, all it is just the hard left agenda that's out there that's so pervasive and affects everything. That being said, these are journalists and their job is to put together journalism today is not what it was, right? You know, and when we had all like the Watergate scandal and all this kind of stuff, you know, big stuff from history, and these journalists, I remember the movie about Cambodia, The Killing Fields. Is that about Cambodia? You know, about the journalists that were over there in Cambodia and all that kind of stuff. These guys were real journalists. Journalism today is not what it was, right? But the journalists are just doing their job. So I have no kind of bitterness against them as people or anything like that. They came in to do a job, and if that was their objective, they got the job done. I don't think they'd done a particularly good job at spinning the narrative that they were trying to spin, but you know, they got a production made and it was in the middle of COVID, and, you know, fair enough to them. But you're right, there was a lot of stuff cut out, and there was a lot of stuff that they were trying to get me to say and all that. The way this kind of came about is they wanted to investigate the industry, and I had kind of given them pointers on, here's some of the companies that you should look at. These are good companies, these are bad companies. And over the course of COVID, which is when this happened, they lost half their story basically, because the Channel 4 and all this kind of stuff started to do exposés on all the people that I had pointed them to.
Yep.
So it's old news. The BBC doesn't report old news. You know, the BBC likes to be the first ones. So it's my understanding that they lost half their story and they were left with the good side of the industry and thought, let's try and dig up some dirt. Now, in all fairness, the company IML that they go after, iMarkets Live, they are just like some big American cult. You know, it's crazy. But what was interesting is they didn't actually go after KB, my company. They tried to use me to go after FTMO, which is a proprietary trading firm.
Yep.
By the way, FTMO is the highest regarded proprietary trading firm in the entire trading space. They've won Europe's Fast 50 award like 5 years in a row. They headline, you know, all these financial conferences and all that. They're a huge firm. And back in 2020, they weren't massive, but they were still pretty big. Anybody who watches that documentary now, who knows anything about trading, would know it's a load of nonsense. But I remember the director, who was also the camera operator. They had a small team because of, you know, lockdown regulations. I remember the director filming me whilst I was on the phone to a client, and he said, ask him if he'd rather work in KFC. And I said to him, you know, I'm not going to say the guy's name, but I said, I'm not going to say that. And he's like, why not? And I'm like, what do you think this is? They had an understanding of, you know, kind of this Wolf of Wall Street type of thing. And
yeah.
It's just, I remember them coming in to record and they said, like, don't punch the desk or anything like that. And I'm like, what do you think this is? Like,
I don't know.
Some 80s stockbroker. So there was a lot of little things like that. They told us that this guy, Dion, was like a young guy really interested in trading.
He wasn't.
He came to our trading floor, right? And if you're really interested in trading and you come to trading floor, you're going to be in, you can be asking questions and all that when cameras are off. Cameras are off. He's sitting on the ground outside on his phone, And I'm like, is this not the kid that's like massively interested in trading? Cameras turn on, he's like, you know, doing all that stuff. And I'm like, what is going on here, man? So it was just a production, and, you know, fair enough, they got it done.
I think, you know, it's important to give a bit of balance, because, you know, my brother works for the BBC. He's a war correspondent, you know.
That's real journalism.
He's based out in Israel, and well, in Lebanon he lives, and, you know, he's kind of covering all the kind of Middle East and all the shit, and the danger that he consistently puts himself in is saying that you have to be wired slightly the wrong way to be
100%
to do that. But what frustrates me more is the cheap journalism and the lack of objectivity in some of this stuff that the BBC's putting out. And, you know, it's just a shame, because it takes away from, you know, the reporters that are putting themselves in serious danger to report on what's actually going on.
That's the difference between, you know, that's why I mentioned the killing fields and, you know, those journalists that were out, American journalists that were out in Cambodia. That's, you know, war correspondence, stuff like that's real journalism. You know, people who are actually boots on the ground, actually investigating things, real journalism. People who are writing scripts to put together, you know, a narrative, that's not journalism. You know, they're like Tucker Carlson, he's just recently interviewed Vladimir Putin.
Yeah.
And that's going to be, now he's potentially not going to be allowed to enter back into the United States. He's potentially going to have travel bans from like all the countries in Europe and all that kind of stuff. That's real journalism. Journalism has a cost, whether it be time, whether it be health, whether it be risk, whatever. True journalism has a cost. True journalism isn't just going and taking lumps out of somebody else, and that's what a lot of journalism is today, unfortunately.
Yeah, and it's symptomatic of social media, because they're fighting a war for attention, and, you know, the clickbait stuff does it, unfortunately.
Yeah, exactly. Drama. People like a big story, don't they?
They do. I always end the podcast with the same question, and that is, what does real wealth mean to you?
Yeah, that's a great question. Real wealth to me is not monetary at all. I don't want to sound too cheesy or anything like that, but something that most people know about me is I'm a born again Christian. I follow Jesus. Real wealth to me is just that, you know, family and a relationship with God. That's real wealth to me. I became rich the day I became a born again Christian, which was about 3 years ago. And at that time, I was going through a time in my trading where those weren't very good. You know, I was going through a bad period. Business, I was going through a bad period. I lost a large chunk of my net worth in an investment. I had to get rid of my car, all this kind of stuff. But that's the day I became rich. And I have often found that in times when I've you know, had the most on paper, I've felt the least wealthy, you know, because it does draw you away. Your attention does shift, you know, from spiritual things and from family and that kind of thing. And finding the balance, you know, is absolutely essential. But that's real wealth, not in monetary things. I spoke to, and this is probably a great thing to speak about here. I spoke to something I love to do, you know, as a Christian, I love to share the message of the gospel with people. And, you know, we sometimes do that via leaflets. Yeah, people from church will hand out leaflets. I mean, if you're standing next to somebody in a Starbucks queue and they, oh, nice day and all that, and you strike up conversation, oh, here, can I give you this leaflet? But I like to speak to people on the street, and, you know, buy them a coffee or whatever, sit down and have a chat with them. And here it was, you know, a cold day, it had been kind of wet and all that, and I saw a chap sitting on the street in Glasgow, and I went over to encourage him and see if I could help him and all that kind of stuff in any way. Didn't want money, didn't want, you know, anything like that. Just started speaking to him about the gospel, and it turns out he was a born-again Christian himself. And I sat there next to him, and we spoke for, you know, maybe 10, 15 minutes, and I left with tears in my eyes, because I was feeling a bit down, you know, that day, and I'd went there to encourage him, and he had actually encouraged me, and with a big smile on his face the whole time and all that kind of stuff. and someone who had saving faith in Jesus Christ. That man is richer than I am. You know, we have the same faith, but he, in that situation, how strong his faith was, even so much that me having a bit of a down day, he was able to pick me up. You know, that there was a richer man than me.
There's not many people that would be open enough to have received that, because, you know, you got huge benefit from that in the day, but there's not many people that would be open enough to strike up a conversation with a complete stranger in the street, because quite honestly, nowadays, a lot of people go around with, you know, a really negative view of the world, and anybody that might approach them, and, you know, it's like a stranger coming to talk to me, he must want something, he's trying to get something off me, right? I need to get out of this situation.
People have very negative views of homeless people as well. So people step over homeless people, think drugs or, you know, alcohol or whatever. 9 times out of 10, you know, from those that I've spoken to, the drug problems and the drink problems come after they become homeless. Because how do you go to sleep when it's, you know, -2 and you've got a summer sleeping bag and a beanie? Like, well, if you've had half a bottle of whiskey or half a bottle of vodka that you found, you know, in a bin somewhere, it makes that process a lot easier. Or if you have, you know, a hit of smack or whatever, it's going to make that process a lot easier. So people kind of write these people off as they must have done X, Y, and Z. A lot of times it's not the case at all. It's unfortunate circumstances, but they are the realest people you'll ever speak to. You know, you speak to people. I've sat at tables at you know, private lunches with bankers and brokers and all that kind of stuff in London, and the conversation is this deep. You know, it's about the whatever spec someone's golf clubs are, and, you know, all that kind of stuff. And I'm just sitting there like, my goodness, you go and speak to someone who's been living on the street for 5 or 6 years, as I often have, you know, the opportunity to do. Some of the most amazing life people, and it's very, very humbling, very, very humbling. And like I say, that chap, I went there to encourage him and all that kind of stuff, and I left him having basically just picked me up, you know, when I was down. I'm thinking this guy should be down, you know. It was wonderful.
That's a great answer to that question. Probably one of the best we've had. Sam, it's been a pleasure to talk to you. If anybody's looking to get in touch, check you out, where can they get you?
Yes, you can fax me at, no, I'm kidding. So I'm on Twitter, I'm on YouTube, Sam KB Trading on YouTube. I share, you know, a lot about my life, you know, when my wife was pregnant and all that kind of stuff. I share all that on my YouTube.
Yeah.
And I've amassed a pretty loyal following on there who's super interested in my life. Instagram for all the highlights. By the way, Instagram is just highlights of life.
Yeah.
You know, so many people look at you on Instagram or whatever and they're like, wow, your life. So listen, 99% of your life does not look like that, you know, so well, you know, polished and all that kind of stuff. But Instagram, YouTube, Twitter, if you want to see me having beef with, you know, fraudulent people in my industry. But I'm on LinkedIn and all that stuff as well.
Perfect. We'll put those links in the show notes. Thanks a million. This
Fantastic.
has been the Real Wealth Podcast. I'm Alex Robertson, and thanks for joining us on this wealth journey.